This conference will now be recorded.
Hi there. My name is Sean Yoder. I'm the co-founder of Aldertine Cannabis CFOs. I wanted to talk to you a little bit today about how to know your tax person or CFO does not know shit about cannabis. Uh, this slide here comes courtesy of Raymond Guns, COO of Dope CFO. This is a part of a presentation that we will be giving at as a panel on August 27th at CannaCon in Chicago. And I just wanted to really dive into this today because this really struck me as somebody who deals with these issues all the time in the industry. I kind of want to bring it to people's attention that they may or may not know. We understand that the cannabis industry is very difficult, especially in the legacy industry where I live here in Northern California. You want to work with people you trust, and I get it. I get the reason that trust is a big deal in this industry. However, sometimes you have to let trust go. That sometimes auntie or grandma or mom or spouse is not the appropriate person to be doing your accounting, or even someone that you know and have known for a long time that's done your personal taxes for you may not be a cannabis expert. So we want to go through and kind of give you some red flags, both as accounting professionals out there prospecting for leads, and also as farmers out there, dispensary owners, people in the industry who have plant touching operations. How to properly vet someone who is in this industry so that you're getting the right person. So the first thing that I want to say is that they're going to speak in terms of deductions, and they may see 280E deductions, but I hear this all the time, even from people who are seasoned accounting professionals. Deductions, and if you read 280E, 280E is very, very simple. It says no deductions. So immediately when you hear deductions, you're going to want to have a clarification to see what they actually mean. No serious accounting professional, they may use it as a translational term to help a layman understand what's going on there, but nobody who's actually doing the books as of the CFO level is going to call them deductions. They're going to call them cost of goods sold because that's all you have available to you as a farmer is 471.11. You have far fewer of 471.3 with the dispensary, which is why we see a lot of dispensaries with cultivation attached on as a vertical integration to help with those with 280E. Um, they're also going to say that XYZ is deductible under 280E. They're going to tell you things that are literally are not deductible under 280E. And they're going to want to put them all into either they're going to do it wrong, which I've seen plenty of. I've worked for plenty of accounting firms out there, just so you know, that are not speaking anything to 280E on the books. They're literally business as usual, taking common deductions, like sales travel, which is a no-no. They're taking things like depreciation beyond gap level depreciation. So they're taking things like double declining balances, things that are not allowable under 280E. And you'll hear aggressive tax preparers who want to save their clients money up front. They'll go ahead and do that stuff only to have the client get dinged later on by the IRS with huge penalties generally. So be careful about that. There's nothing deductible under 280E. There's no aggressiveness to 280E. There's no beating 280E. The other thing that I see on a regular basis, I visit a lot of dispensaries, and one of the most common things that I see and I ask people about, and this is usually what trips them up, and I can tell right really quickly whether I want to serve them or not, is I ask them about cycle counts. If someone understands cycle counts, you're either going to get two things from them, two responses back from them. A manager of a dispensary is an excellent example, somebody who actually has to carry out the cycle counts. You'll get a response back from them about how tedious the procedure is, how they dislike it, how they need more help, those types of things, or they're not doing it at all, but they are aware that they need to do it. Those are the two that you're going to get from people who want to play along by the rules. The third you're going to get is cycle counts. What are those? And then you know right away that they have no inventory procedures in place, and if it's a large dispensary, they're going to get dinged by the IRS. No inventory means that you're not doing proper gap cost accounting, accrual cost accounting, and that means that you are essentially giving the IRS way more money than you should, or you're possibly underpaying on taxes. Either way, you're going to run into issues with the IRS, either giving them too much money or not giving them enough. And if you're giving them too much money, you're hurting your cash flow and you're not adding any value to your business. If you're giving them too little, they're going to come after you. There's going to be an audit at a certain point and they're going to assess a lot of penalties. We see it all the time. And so cycle counts and having a good inventory procedure. And I know it's not easy, but that's something that you absolutely have to do. Cost accounting is not a common topic, by the way, or spoken about regularly. I cannot stress this enough. Most accounting professionals I talk to, they say that they're a little dusty and rusty, and they had to go back and reread their college textbooks about cost accounting. It's not something that comes up every day, unless you live in a place like Indiana and you work for a Caterpillar or GM tier 1 or tier 2 manufacturer supplying parts to those companies. Then you're going to know all about cost accounting. Anytime you're creating a widget where you need to know units of cost, you're definitely going to know about cost accounting. Many farmers have an inkling or notion of cost accounting that just needs to be formalized. They are obviously not operating under 280E, but they have a somewhat of an understanding. Farmers may have somewhat of an understanding of cost accounting. My experience in cost accounting comes from working at the Sierra Nevada Brewing Company, where the people there who are in charge of the cost accounting all had bachelor's of science degrees in accounting, not just BAs, they had BSs. They knew and understood the idea of deriving those costs from inventory into cost accounting and proper GAAP accrual accounting. It's a very complicated process, but once you understand what you're trying to do and what you're trying to accomplish, it's not that difficult. You just have to understand that you're coming about it from a very, very different way. You're trying to get that cost of goods sold. The last part, and this is just the one that we still continue to see, and why it's an issue, I don't know. But this is the number one red flag that your tax person does not know shit about cannabis. They're still spouting logic from 2012, 2013, 2014. Create as many entities as possible. Try to baffle the IRS with bullshit. Well, you know what? The IRS isn't baffled by bullshit. They never were. And if you look at case after case, the IRS continually wins on the multi-entity structure because they know it's a scheme. And the scheme is that you're going to create non-canon divisions without any sort of paperwork separating these things out. And if you look at the Champs case, which is pretty cut and dried, and it's definitely not a multi-entity situation to beat 280E, it's logically constructed, but they also have paperwork showing the internal processes and how they came derive their decision. So if you're going to come up with a weird entity structure that works for your business and you were worried that the IRS might nab you for it, a good person who understands cannabis and is serving your company properly will create a situation that's not going to beat 280E. It's just simply going to be compliant with 280E, and it's going to be properly documented so that if you do get hauled into tax court, it's all going to make sense. But if you're just creating entities to create non-canon divisions to hide all of your losses and to essentially be able to take deductions that you wouldn't normally be able to take under 280E, you're going to lose in court because the IRS doesn't see it that way. They don't see it as multiple entities operating alone as standalones. They see it all as one ongoing trafficking enterprise. And as long as you understand that the federal government sees your business as a trafficking enterprise and you fully understand that and are aware of that, and you have someone on your team who's handling your accounting that also fully understands that, then you're going to do just fine moving forward. But if you have any one of these 5 things here that you're worried about, that you've heard your cannabis accountant or tax person or CFO say, you're going to want to get rid of them immediately and you're going to want to replace them with somebody that's actually an expert in this. You can always give me a call. My phone number is 530-680-6371. My email is office@aldertinegroup.com. And again, my name is Sean Yoder. I'm the co-founder of Aldertine Cannabis CFOs. And remember, hire someone who knows something about cannabis. If they do not hire them. They're not adding any value to your company. Thanks.